Welcome to Smart Simplified. Is there a recession in 2022? Recently, the yield curve inverted. This is a sign that a recession is imminent. Is this a different time? What time do we have to wait? Market fears of a recession are increasing. The worst fears have finally been confirmed. The most reliable recession signal. Predictor of the yield curve in the United States history. Inversion. Are we headed to recession? People are always looking for ways to get around. There is nothing more we can do. Music. Many indicators can be used to determine the health of your business. Analysts and economists used to try forecast when recessions are likely to hit our shores. These are all great feelers to have. They are used to gauge the economy but not for economic purposes. The reliability of one of the above is rare. Extremely reliable indicators. The 50-year-old history of economists is what's also known as the yield curve inversion. I'm sure you've heard this has been the case for the past few weeks. This indicator predicts the future. 6 recessions that were a 100% the hit rate for every yield. Over the past 50 years, the curve has been inverted. Years later, a recession followed. Please take a look at this graph to see where it takes us all. Back in 1976. August 1978 was the year we witnessed what is now known as an inversion. Occurs when the graph falls below that. The black line at 0 and 10 years. Treasuries yield lower than other investments. I'll show you why 2-year Treasury bonds are so popular. This is crucial later in the video. However, 16 months after the event, inversion, we see the Volcker recession. In January 1980, the yield was okay. Curve inverts but not immediately. Reversed again mid-August 1980. We see it months later, in July 1981. Recession then. Follow that pattern for the next 10 years. So the yield curve is back to normality, prevails over the recession. Then, December 1988 arrives, and the dreaded yield curve reverses. So July 1990, 19 months later, in short, and so again, a quick recession occurs. The same thing happened in January 2000. Before the tech bubble collapsed, the yield curve inversion is the same as in 2008, before the inversion of the excellent recession yield curve. It happened, and it did so very recently. Before the pandemic of 2019, we saw this inversion of the yield curve has been called an inversion of the yield curve. A terrible and almost unstoppable habit. Predicting recessions is the reason we do it now. This is why it is so relevant to us today. I'm sure that some of you know this. We've seen it on the news. What do you think we should do? Just recently, the yield curve was revealed. It's been inverted, and it's gone below the black line. All economists are left with zero. Investors are terrified. A recession is on the horizon. It is coming. How far is it? What do you think we should do? I'm going to. All of these topics are covered in the video. So how long are we going to have before the? What did the yield curve do? Stats don't prove this, but they do so based on past data. 6 recessions in the shortest amount of time. There were 6 months between the yield curve and its completion. This is the inversion and the recession. Recent pandemic. The 2020 recession. It took the longest to get there. Was the significant financial crisis that lasted 24 months between the inversion and recession. Can happen anywhere. The average time between 6 and 24 months is the period between the inversion and the recession. Is the average time of recession across all countries. Receding is for 14.8 months, so that's just. The peak was reached in just 1 year. Predictive power lasts approximately a year. You may not know the future, but you have a few years to go. If we look back at the past, it's a good half. You still have plenty of time. Before we see a recession, now that there is, the yield curve has been inverted, which is a scary thing. Remember that the past is not a guarantee of the future, but it does give us an overview. Guideline. So what is the yield curve? What does it mean? And more importantly, why is it important? Works so well that it can be used as a recession predictor. When people first mention the yield curve, all they talk about is the Treasury. The yield curve is the Treasury's yield curve government department, in charge of finances and how to get money. You can borrow it as treasuries. Anyone can purchase this bond. They'll receive a return check from the Treasury. This bond yields a range periods of between 3 and 30 days. For years the government takes your money. It can be used for anything. You get interested, and your money back after some time. It is now customary. The yield is higher for more extended periods. You get more because you take on more. You're taking a risk and locking your money away. It is possible to keep it for a longer time. You want to make more money with this. However, in times of uncertainty or fear, the yield curve is what happens most often. Inverts are also known as the longer time that you spend. Your money is locked away with the lower yield. You see, investors are so successful. They are worried about the short term. They will need high yield for short-term investments. They are also open to accepting a lower price. Do not yield to keep your money locked up away for long time. Could you do this? So we looked back at the past 50 years and found exactly what was right. We have seen this over the past 6 recessions. This indicator was 100% true, but let's not forget to go back further. Because it hasn't been precisely 100% over the longer term. History shows that the data proves you can make a difference in your life. You can go back to 1900 for the 28 inversions of yield curves. That have 22 of them occurred in the last 120 years. The recession was followed by 22 of 28, an accuracy of 78. Unfortunately, I couldn't find any graphs that go back to 1900. This will allow you to see the illustration visually. Between yield curve inversion, I did not find a recession, but one that works back to 1929. So here are a few things I need to do. This graph is the first to be mentioned. Group of recessions that took place in the 30s and 50s. There is something for everyone. You'll be amazed at this. This period is so short that you don't know what to expect. It is impossible for a recession not to happen. All of the time since 1929, we have seen a recession. So in 1929, great. It had reversed 1958-1. We saw an inversion of the recession. 1960-1961, another inversion was preceded. Before every recession, there was an inversion. And also to highlight one. More importantly, it is often before the recessions cause the curve to invert itself. As you can see, the angle was created around 1990. Uninverted before the recession. It was uninverted before the downturn in 2000. It is the same as the 2007 version. There was an inversion before the reckoning occurred. The primary yield curve, but many economists use. If you look at the headlines, what are they saying? It is now they are all different, and each has their key. This is one of the main reasons. This is due to all the buying that has taken place. What the Fed did in the Treasury bond. Market investors tell you not to worry. The inversion is because it's manipulable. The Federal Reserve supports the Fed. Purchased $3.26 trillion worth treasuries as of March 2020. $1 trillion have been in maturities of 5 to 10 years. And $1.4 trillion in maturities 10 plus years. So analysts say the Fed is manipulating the bond market, and possibly this time, it's different. We won't see another recession. However, the real problem is in financial matters. Analysts were saying the same thing. It's an entirely new experience in 2019 when it is inverted. It's always quite scary. It is important to note that every time is different. I'm going to say it to the yield curve inversion. There is no chance that the inversion will occur. The yield curve is currently occurring. This period is very similar to the previous ones. This happened during the previous period. It will cause a recession, and it will. We all know what happened following the 2019 election. We had the inversion of it indifferent. Pandemic recession in February 2020. They could be right. This time, it is different. But most people will agree with each other. Stats show that this is the case most of the time. They are wrong. Remember that the 10-year minus is what it is. The 2-year yield spread that we have observed that this was recently inverted. Many economists consider this to be the main one as to be focused on. Let's look at the others. Could you take a look at all the yield spreads? This may allow us to understand better what we are doing. The bond market tells us, as a whole. First of all, we have the 10-year guarantee. The 1 year that hasn't been inverted is minus. It isn't yet, but we are on the right path. The 30 years was minus the 10 years, which is not reversed again, but it is. We're very close to inverting, and we have it. The 30 years less the 5 years, which has been changed and gone into negatives. A 30-year term yields less than a 10-year bonds, are more affordable than 5-year bonds. It is strange, but there is one curve against the grain. That's the 10-year. This is the Treasury without the 3-month extension. The curve has been growing over the years. It's not even close to the level it was in the last year. Inverting this way tells us that bondholders love accepting bonds. Lower yields on 3-month treasuries. They aren't too concerned about. The economy and interest rates have been very stable. Believe that many market pros believe in the short term and are highly skilled. This 3-month period is equivalent to 10 years. Yield is a better indicator of recession. Forecaster and the fact the curve could be translated as the economy will not be sustainable in the short term. At least in the immediate future it could be wonderful. Okay, let's sum it all up. Yes, there was a yield curve flip. A pretty accurate predictor of recessions have happened in the past, however. It takes, on average, between 6 and 24 months before a recession happens after. So if anything, we have a little bit of time. Go historically, equity markets tend to produce the highest returns in the months and quarters that follow. Inversion may be possible in the short term. We'll be fine, and we'll see what the market has to offer. Let's go up and watch. English, auto-generated. Thanks for watching. Subscribe, like, comment and share.